December is a seasonally strong month historically. What do you need to see after this week, November?
Well, certainly all eyes are on the Fed. I think that's pretty clear. And, I've been a voice that we're going to get this cut kind of through all the ups and downs. I think we are still going to get this cut. And I think that's going to be meaningful for a lot of the players in the market, particularly, of course, small caps who we know suffer with higher interest rate burdens versus their large cap peers. And they haven't done terribly this year, but they're certainly, kind of below large caps and looking for that trigger, that spark. With the valuation chasm we kind of have between large and small at this point, I think getting that cut and sort of the stimulus that we can expect in the coming year is going to be very good for those parts of the market. And I think that's super important because obviously what we're feeling right now, of course, is exactly what you started this segment, concerns about AI, concerns about the fact that what's really driving everything that's going on in the stock market for the year is this AI trade. And the AI trade may not pay off as quickly as everybody wants. So I think it's going to matter a lot what we see this December decision. And it's going to matter for parts of the market that we need to try to hedge our bets a little and put more into.
Michelle, will December bring back the return of the bullish trade on AI? What are your charts saying?
Well, I don't know if I necessarily see a lot of upside in the AI, and I agree with Dana completely. I think this is really when you have to look out. Whether or not the Fed cuts this time, they will, I think, in 2026. So it might send a little bit of a nervousness through the market if they don't. But nonetheless, I think that would be another buy opportunity because it's inevitable, just like she said. And so as far as AI goes, I think you have to be careful. Excuse me. Where you have to look. And we're looking more at the software side and the energy side. We're looking at sort of the infrastructure here rather than the companies themselves that have really been outperforming to this point.
Inez, on the positive side here, the AI trade has come back over the past week and a half. I mean, we had that reversal what NVIDIA reported a few weeks ago. That spooked everyone out, but things have stabilized a bit, and I think that's good.
Yeah, the AI trade has come back. We've also seen the sort of impact on productivity when you talk about AI tools and also with Alphabet. I mean, Alphabet has really been the one that has stood out. I mean, month to date, it's up more than 20%. The TPUs chips, which aren't replacing the GPUs, but it's a form of diversification for these hyperscalers. Their Gemini tool, I mean, earlier this year, you had Wall Street very concerned about perhaps their Google search being impacted. Well, they're integrating that into the tools. And also one other note, I mean, I was listening to also Lynn Alden, a macro strategist, who was talking about how AI is being used so much for videos. And guess who's got a massive video platform? Alphabet as well. So certainly I think that it infused sort of more optimism, even more optimism, despite the fact that you're talking about, oh, is there a bubble in AI? Well, you look at Alphabet and its performance this month, and it has really roared.
Yeah, Dan, absolutely. I mean, Alphabet has certainly roared. Is that the new canary in the coal mine AI stock? We've seen different companies take this crown throughout the year. NVIDIA, of course, has led the AI way, but Oracle gained a little bit of a market leadership position when it came out with its giant backlog in September. Is it now Alphabet's moment?
It's an interesting question because what I've been waiting for in this trade is when is the driving stock, if you will, going to be one that actually shows productivity increases from AI, right? We keep
profits, right?
Right. Certainly profits are there, but to a certain extent, we know that we haven't seen the productivity gains from AI filter into kind of these different companies. And if a company like Google comes out and says, we've been able to do X, Y, Z, our productivity has increased this much, our efficiency, we expect this, and they really show hard numbers kind of around that, then I think sure that could be a telling kind of bellwether. And I don't think AI is going to filter out through our economy in all sorts of ways. There will be winners, there will be losers. We don't really know yet. But I do think the market is kind of searching for that, hey, we actually think we've cracked the code here on how to use this, as opposed to, great, we just got another contract for, the infrastructure for AI. I also agree with the comment on energy. I think to the extent that we know that the CapEx is not going anywhere, you just talk to folks in real estate, right? It's all data centers, right? It's all that's where all the dollars are going. That's what the deals are. So I do think as a secular trend as well, energy is kind of necessary. Just, population growth, people hopefully getting better standards of living over time. I think that's a place to be. But as far as the AI bellwether itself, I'm looking for one who actually comes out and has, kind of the benefits of AI filtering in.
And a note to the Alphabet team, you want to rent out my one bedroom to stick some servers in it, $50,000 a month, it's all yours. I think that's pretty cheap. Michelle, we've mentioned that the AI charts, they've broken down relative to the highs. Is the reality that once these charts, or once these momentum tech names come off their highs, that a trading range might be the near-term course of action?
Yeah, I don't think we're going to see major downside. And yes, I mean, again, Dana is right on there in terms of where we're going to discover the uses, the practical uses of AI and what people are willing to spend money on. Because right now, most people that I talk to talk ChatGPT that they're not paying for. So when you're looking at something like Google or Alphabet, you're looking at Gemini product, or Waymo, which, by the way, is another area that is growing in terms of their cars. So essentially, Google has a great story, but we do, in terms of the Magnificent Seven, have to see something more in terms of the consumer. So Apple, you show up there, we want to see what happens here, particularly Black Friday. I think Microsoft has had its own issues. We're really looking at Microsoft more broadly in terms of infrastructure. And then NVIDIA, of course, there's competition that's going to start to emerge. So you have to pick carefully here, number one. And number two is, like I said before, as long as it doesn't sink, that would be a negative to the market. It can kind of move to the side and let the money flow elsewhere, which would actually in some ways be a healthier sign for the U.S. economy in 2026.
Today, the yield on the benchmark 10-year hovering just above 4%. Joining me now is Gunit Dhingra, BNP Paribas head of U.S. rate strategy. Gunit, always great to see you, especially on set. Let's start with the Fed meeting next month. Will they cut? Should they cut? What's your take?
Yeah, thanks for having me on, Josh. We at BNP have been very clear. I think the December meeting was always going to be a rate cut meeting. One thing we have seen with Powell in the past is he tends to go in episodes. So taking a break in December would probably have meant that there probably won't be more cuts down the line. So December had that sense of continuity from September and October. Plus, I think the economic justification, at least to the extent that Powell wants to focus on the labor market, is there. The unemployment rate has ticked up by 0.3 percentage points in the last 3 months alone. And we think the economic rationale is there. At this point, we do think they have the votes as well. So we are firmly in the December rate cut is happening camp.
What are the risks of cutting, though, into this time where, listen, the government shutdown's over, so you would expect a snapback? The Trump tax cuts, the big, beautiful bill. What are the risks we should think about there?
Yeah, so I think you're right to point out those risks, because right now, even though the rate cuts are going to happen probably in December as well, I think markets are not convinced that we actually need those rate cuts at the same cadence. So we've talked about this gap where what the Fed will do and what the Fed should do has been different for quite some time. Inflation numbers are running close to 3%. I think the risk also is that people think that rate cuts that happen with dissent, which is also a big feature of rate cut policy these days, particularly next year, where I think a lot of the hawkish voters on the committee become voters. Those dissents, I think, are going to make it very difficult for the market, particularly the 10-year point, to follow off these rate cuts. So the Fed can cut rates in December, but we don't think the 10-year rate's going to follow that.
Yeah, I wanted to ask about this. Well, just sort of this concept you brought up in a recent note, Gunit, about this kind of fractured Fed. And your team pointed out, listen, it's a rowdy, disorderly process. So rowdy, disorderly. I mean, how does that dynamic, just walk us through how you think that impacts the easing cycle going forward.
Yeah, so I think, look, historically, a rate cut, you go back in history, it's hard to find meetings where rate cuts there are more than 1 or 2 dissents. Maybe 3 once in a while, but that's very, very rare. In fact, I went back and looked at the history of dissents for the last 25, 30 years. Very rarely you get those dissents. Right now, the way these public speeches are going, it is very possible next year you will have possibly 2, 3 dissents, almost on an ongoing basis. Some dissents for possibly bigger cuts, some dissents for possibly less cuts. And so I think these fractures in the committee are becoming more and more prominent. And next year, this is why I think the market's going to struggle to price the lower rates, because the cuts won't be convincing in light of those dissents.
On the labor market, I thought you all had an interesting point of view. You say job creation declines, you guys say, due to immigration policy, not cyclical weakness. So does that mean the softening that our central bankers expect might not show up?
Yeah, so I think the immigration policy has been part of the reason why the break-even rate of job growth has been much, much lower. A 50K job print in this environment is probably enough to keep the wage levels on an upward trajectory. So right now, what's happening is we think the unemployment rate, which cancels out the supply and demand of labor, that unemployment rate has become the judgment factor on which you judge the labor market, not the number of job gains. And that's why I said when unemployment rate has gone from 4.1 to 4.4 in the span of 3 months, I think that is economic justification for now for the Fed to keep cutting.
Switching gears, there was a good piece in the Journal, Gunit, right in your wheelhouse, and I want to get your take on this. The piece is the headline: "Flood of AI bonds adds pressure on the market." I don't know if you saw this. They said here's a number: since the start of September, they say the AI hyperscalers, those tech giants, they have issued nearly 90 billion of investment-grade bonds. They say that is more than they had sold over the previous 40 months. What should we make of that as investors? What did you make of that?
Yeah, no, I think that is a very interesting dynamic. And I think what that tells you is a big theme, I think, for 2026, particularly for me as a rates watcher, is AI is becoming more than just a CapEx story and more than just an equity market story. It's going to bleed into the rates market via these technicals. It's going to bleed into the rates market via the macroeconomic impacts. Specifically on the technicals, if you think about the issuance numbers that you mentioned, those are mind-bogglingly high numbers.
Totally
I think the issuance of that magnitude, we've heard about this idea of overcrowding or crowding out. In the past, the treasury market was crowding out the private sector. It's quite possible next year it's the private sector hyperscaler issuance that might start to crowd out the treasury market. And so that's one more reason, among a litany of reasons, why the long-end rates will struggle to go down in 2026.
So let me get you out on this. Your clients come to you, they say, what is the opportunity in 2026? What are you telling them?
Yeah, so I think short-term rates probably going to hang out here, maybe a touch lower, maybe a couple of cuts in 2026. But I think long-end rates are going to go higher. We are thinking about getting close towards 4.5% next year.
Gunit, always great to see you, especially on set. Thank you, sir.
Thank you.
Fed also in focus, of course. The odds of a rate cut now even higher. What is driving that move?
Yeah, moments ago, we actually learned that San Francisco Fed President Mary Daly says she now supports a rate cut in December. She told the Wall Street Journal in an interview this afternoon that she sees a significant deterioration in the labor market now that is going to be more difficult to tend to than a flare-up in inflation. Now, her comments coming just after this morning, Fed Governor Chris Waller, who is a voting member, expressed support again for a rate cut in December, also saying that he has concerns about softening in the job market. He believes that the stronger September jobs report that we saw of 119,000 will actually be revised down by 50 or 60,000. Now, when it comes to next year, he says the FOMC is probably going to take meetings or interest rate decisions meeting by meeting. But all of this goes back to what we heard on Friday when New York Fed President John Williams really changed the sentiment in markets, saying that there is room for a cut in the near term. And since then, we've really seen odds shoot up this afternoon. Investors placing bets about an 80% chance for a rate cut next month. Josh.
All right. Thank you, Jen.
But the market seems to be paying most attention to John Williams, who's singing the song they want to hear.
Amen, Julie. Yep, that's right. New York Fed President John Williams signaling that a rate cut is on the table for December, something that markets thought may be in doubt after that stronger than expected jobs report for the month of September. Williams saying in a speech in Chile this morning that, quote, "I still see room for further adjustment in the near term to the target range for the Fed funds rate to move the stance of policy closer to the range of neutral." neutral. He sees this even as he noted that progress towards the Fed's 2% inflation goal has stalled temporarily because of tariffs. He thinks tariffs is adding anywhere between half a percentage point to 3/4 of a percentage point to the inflation rate right now. And this is notable because, yes, it comes after the September jobs report that called into question whether the Fed would move forward with a rate cut in December, but also because he's part of the troika, as we like to say, which is Chair Powell, Vice Chair Philip Jefferson, and John Williams. And if John Williams is in the camp of seeing that a rate cut is on the table for December, then perhaps logic holds that Chair Powell and Jefferson and maybe other members of the Federal Reserve Board are also in the same camp or could be swayed to be in that camp as well. And we did hear from Jefferson earlier this week, who seemed open to the notion of a rate cut. He sees the greater risk to the job side of the Fed's dual mandate, which is where the market was sort of inferring that perhaps he could side on another rate cut for December. Now, we did hear from a number of other Fed officials, a very busy Friday morning here. On the flip side, Susan Collins of the Boston Fed, who is also a voting member for December, she seems more inclined to hold the line. She said that the September jobs report has not changed the picture for her much. She's paying more attention to those weekly jobless claims, but she's taking more signal right now from underlying resilience in the economy and concerns about inflation that she hears from contacts. So while she hasn't made a decision yet, she is more hesitant. She feels that the Fed needs to maintain a mildly restrictive stance at this point. So less inclined there. And we did also hear from two other members of the Fed who are not voting members, but who also seem cautious. We heard last night from Anna Paulson for the first time from the Philly Fed, who says she is moving cautiously into December and that with each rate cut, the bar for future rate cuts becomes much higher. We also heard from Lori Logan this morning, who was speaking in Zurich, who reiterated that she didn't think that the Fed needed to cut rates last meeting. And given that the Fed has cut twice already this fall, she doesn't see the need to cut again in December.
Markets are continuing to price in an interest rate cut in December. That's despite Federal Reserve Chair Jerome Powell's recent hawkish comments, saying another cut this year is not a foregone conclusion. And it's not just rate cuts that have all eyes on the Fed this year. Investors are also waiting to see who will become the next Fed chair and what the future of Fed independence will look like due to ongoing pressure from President Trump. Joining me now at Invest is Lael Brainerd, former Federal Reserve Vice Chair, former Undersecretary of the U.S. Department of Treasury, and former Director of the National Economic Council under President Joe Biden. Lael, always a treat to get some time with you. I thank you for coming to Invest. The debate right now in markets, the day after the government shutdown has officially ended, is the lack of data. And the Trump administration has locked in on the fact that we may not get this data from the past few months. How concerned are you about the lack of economic data that's likely to come out?
Well, it is a very unusual juncture. Going into the December meeting, it's just much less clear where the Fed is going to go than it was back in September. And it's not primarily because of the lack of data, although the lack of data just makes it worse. It is because we have heard from both sides of the Monetary Policy Committee that both the hawks and the doves are digging in, with the hawks saying that inflation is 3%. It has been for 44 months now. And it is projected to remain in that territory because of the tariffs. On the other side, the doves are saying that the labor market appears to have softened given the last public sector data that they have, as well as some private sector data. And both sides are right.
Before the government shutdown, Lael, there was a general consensus that the economy was slowing down, as seen through the prism of U.S. labor market data. Why was that happening?
So I think we have a very clear two-track economy. We have the AI sector, and all of the related sectors are seeing record interest in the stock market, are seeing massive investments, data centers, electricity, chips. The leading sector is doing extremely well, but it's not hiring. And the rest of the economy is suffering. It's suffering because it is less favored in the capital markets. It's suffering because it is still trying to digest those tariffs. And then it's also a lot of those businesses are not clear how much should they hire given what they're hearing about integrating AI into their businesses. So for all those reasons, neither the booming sector nor the remainder of the economy are really hiring. And meanwhile, you have very divergent economies.
Is the economy in a recession?
I would say you saw the second quarter growth number coming in very strong, 3.8%. Consumers remain resilient. Now, we know that that is the top of the consumer income distribution, but they do remain resilient, driving spending. And all the estimates are that third quarter GDP is going to come in quite similar. So the economy at the top level is strong, but again, it's being driven by this really important set of investments in AI. The rest of the economy under the hood is really stuck.
You bring up a good point, Lael. Why do you think the wealth we're seeing built at the top end, as seen through the prism, of course, of the stock market, why isn't that trickling down to the average household?
So you saw it in the election. Clearly, people in the lower half, even the lower 3/4 of the income distribution, are really concerned about affordability. They've seen prices of coffee and bananas going up, housing costs not coming down, utilities costs going up. So they're very worried about that, and they're worried that their job opportunities are not as good as they were a year or 2 years ago. You see that in the consumer sentiment surveys. Whereas that top 10% of consumers, their housing values have gone up, and of course their stock portfolios are very positive.
I'm glad you mentioned coffee and bananas, Lael, because the Treasury Secretary, Scott Bessent, is out this week saying the administration plans to put policies in place to bring prices down for coffee and bananas. Maybe this is the new egg debate. Whatever the case is, you're in government. Can the administration actually do this? Can they bring these prices down for these two key ingredients?
So, look, I think it is interesting, first of all, to see the Secretary of the Treasury and the administration wake up to the fact that people are really unhappy about prices and affordability. Don't forget, just a few months ago when they were putting tariffs in place, he was talking about how, well, there'll just be fewer toys under the Christmas tree come Christmas time. Now, I think they're seeing that actually consumers are really troubled by this affordability. And to some degree, they can take tariffs off where they've put them on. And that is what they're talking about. But it will be very difficult for them to fundamentally reverse the affordability crisis in areas like housing and, of course, in healthcare because of some of the expiration of the tax credits. It's actually going to get worse for millions of families.
Do you believe the higher prices we have seen, coffee, bananas, whatever it is, furniture, apparel, are tariffs causing this inflation? And then do you think the administration will come to regret these tariffs?
So look, I think in areas like baby clothes and strollers and toys, furniture, those are clearly tariff related. You can see the tariff lines. Coffee, bananas are hurt by tariffs, but in some cases there are structural forces that are making these worse. And so, for instance, the demand for electricity is growing at a rate we haven't seen in many years because of the boom in AI, and that is inevitably going to put pressure on consumer electricity prices. And that is something that is more complicated and difficult for the administration to reverse. Of course, it didn't help that they got rid of a lot of the alternative energy incentives. They have brought prices down. We're seeing lower prices at the pump by a little bit. But some of these other forces are going to be difficult for them to reverse without reversing their own policies.
I talked to a noted economist, Lael Mohamed El-Erian, earlier on at our Invest event. He said this, quote, "I believe that this Fed went to sleep. And Mohammed was referencing that the pressure, like you were mentioning too, on lower income consumers. Is the reality that the Fed, that meeting, December 10th, decision day, they need to come out here and cut rates and make it clear that more rate cuts might be needed to ease the pressure on households?
Well, I think they are in a difficult spot because they have the most powerful inflation fighting tool. And of course, with inflation now not continuing to come down, but stalling out around 3%, a little higher, they are concerned about inflation. I think most members of the committee believe that this is a transitory impact. They don't like to use that word, but they do expect the tariff effects to dissipate, so no further increases from tariffs eventually. And the other side of the committee, I think, has been sounding the alarm about the weakening labor market. And that was what we saw in September, very clear commitment to cut 3 times in those projections. But it turns out that 9 of the 19 members were not actually on board for 3 cuts. And so that is what we're going to see play out in December. Even if we see a cut in December, it's likely we would see a pause after that, given where the hawks are on the committee.
If you were still in the Fed, Lael, would you argue for a rate cut?
I would. I would be concerned about the weakening labor market. And I think I would take the risk that perhaps tariffs push prices higher for a little longer against the risk that we really see a self-reinforcing downturn in the business sector that leads to real pain for American households. So weighing those 2 risks, I think as many members of the committee, including the chair, has articulated, they are more concerned about the risk to the downside on the labor market. We just heard that again from Governor Cook. And they're willing to take a little bit more risk on the inflation side of the mandate.
That decision on rates, Lael, is just, of course, one day on the calendar. You look out through this whole year, and it comes against a backdrop of really unprecedented attacks on the Federal Reserve by President Trump and various members of his administration. Are you concerned that these attacks have undermined the credibility of the Fed longer term?
I am very concerned. I think everybody should be concerned because, of course, the Federal Reserve's independence is what is key to its credibility on inflation fighting. And the fact that most people believe that they will bring inflation back down to 2%, that inflation expectations are well anchored, is rooted in that independence of the Federal Reserve. So we've seen, as you said, unprecedented moves to fire a board member without cause. We have seen another new board member appointed while remaining on the staff of the president's office, and ongoing statements from the administration that they believe that the Federal Reserve needs to lower rates in part to bring debt service on the national debt down, which of course is a real violation of Federal Reserve independence if it were to happen. So for all those reasons, I think investors and the public should be carefully watching what happens over the next few months in terms of the Supreme Court case on the firing of the governor without cause, as well as the appointment of a new chair and what that signals.
Of course, the list to replace Chair Powell next year down to 5. Are you confident in these 5 choices?
So the lists that people have talked about publicly, they are all highly qualified individuals. And the real question is the extent to which each of them can truly be independent of the White House and be perceived to be independent, because at the end of the day, it is that public perception that the Fed truly is independent and makes its own calls based on its dual mandate, which is to keep inflation low, keep the economy at full employment. That is what anchors inflation expectations, and it makes it easier to bring inflation to the 2% target without causing unemployment to rise.
Lael, before I let you go, Chair Powell, he's been a constant in markets for years now. What do you think his legacy will be?
Well, I do believe that the single most important legacy will be his very determined efforts to guard the independence of the Federal Reserve, to make sure that the Federal Reserve maintains its institutional strength and resilience. And of course, that is the most important legacy he can hand to future Federal Reserve chairs. It's also the most important legacy to serve the American public, because it means that they can have confidence in low inflation and that it won't require high unemployment to bring inflation down.
Governor Myron, thank you so much for sitting down with me. It is great to have you on the program.
Thanks for having me.
We've gotten a new reading this morning on private sector job growth, and we're seeing that job growth swung positive in October to 42,000 from negative 29,000. A lot of that job growth coming from larger companies as opposed to mid-sized and smaller companies. How are you looking at this report? And given that we don't have official government data, how is it informing your outlook for the labor market?
Sure. So, we always have to be cautious about reading too much into any one report, and that's going to be even more the case when we have a government shutdown, that we're not getting the data that we need to make monetary policy. Now, we are getting alternative data from a variety of sources, like the data that we got this morning from ADP, which is a welcome surprise that it came in a little bit better than expected. But in the context of the overall picture of the job market, it seems like the pre-existing trends that were in place before the government shutdown in the labor market seem to be continuing, at a similar rate. You continue to see, modest potential overall job creation. You continue to see moderation in wages, and you continue to see indications that labor demand may not be as strong as we'd like it to be from a cyclical perspective. All of that, to me, is an indication that that rates could be a little bit lower than where they are now.
How much of this that's driving the job market right now is structural versus cyclical? We know there have been major policy changes that have come from the administration, which take time to work through the economy. What's your sense of that? And do you have the tools, if it is structural, to deal with that?
Yeah, so a lot of the changes to the number of job creation, to the levels of job creation that would occur as a result of policy changes like immigration are what we as economists would call output gap neutral, right? Economically, the role of monetary policy is to balance supply and demand in the economy, and to make sure that you don't have demand so far outstripping supply that you get, upward spikes in inflation, or that demand isn't cratering relative to supply so that you get downward spikes of deflation of the type that you have in a depression-like environment. And so the goal of monetary policy is really to balance supply and demand. Now, if you have changes in, let's say, population growth because you either have a policy of large-scale mass immigration or you have a policy of closed borders and net zero migration, that's going to be what we would think of as typically, in my opinion, output gap neutral. And the reason that's the case is that when you have an additional person in the economy, they're generally consuming as well. They're working and they're consuming. And so from an output gap perspective, it's not clear that there's a very big role for monetary policy to play, because it's not the case that supply or demand are moving by very different amounts. They could be moving by very similar amounts. And so some of the low levels of growth are a result of changing border policy. If you have an economy in which you're throwing in large numbers of new migrants, of course, the overall job number will be flattered by that. And if you stop that, the overall job number will reflect stopping that. But that's not necessarily something that monetary policy responds to automatically.
And sort of building on that, the president has gotten many companies to invest billions of dollars in this country. We're going to be seeing investments in technology, in AI, in factories at the same time. The tax bill has been made law. We've got 100% expensing on PP&E and factories. How much job growth could we see from that? And what is the timeline on that? Is that a 2026 story? And again, kind of going back to those longer term structural versus cyclical trends, how are you viewing that as it relates to the labor market and setting policy?
Yeah, so look, I do believe that the supply side of the economy matters, right? I'm not, I don't exclusively look at either just the supply side or the demand side. I think that they both matter. And as I said a moment ago, the role of monetary policy is to balance them. And I think that there's a whole slate of expansion inflationary policies on the supply side that drive out the productive capacity of the economy. You mentioned some of them, things like the full expensing provisions from the tax bill that was passed over the summer. There's now a huge tax incentive to invest in new factory equipment or to invest in factory structures. I do expect that to result in some additional investment demand. That additional investment demand pushes demand up higher in the short run, and a little bit longer run, it pushes the supply side of the economy out because you can produce more because you have more capital. And that's all stuff that matters when you think about the outlook and when you think about where monetary policy should be. But there's other elements that are pushing out the supply side too. And think about regulations. Regulations really shape the structure of the economy because they decide whether you can produce or not and what you can produce or not. So the industries that you have in the country, how big the industries are and where they're located, can all be a function of the regulatory environment. And as you change those, you can change the supply side of the economy too. And pushing out the supply side of the economy in those ways, and sometimes it'll take demand with it, for instance, and the full expensing, right, will create investment demand. But in other things like regulations, it's not as clear to me that it pushes out the demand side as well, and it actually expands those output gaps that I mentioned a moment ago that monetary policy should respond to. So I think there's a variety of policies that are affecting the economy. They affect the short run, they affect the long run, they affect both of them, and they affect the supply side and the demand side. And it's really important to be thinking about the ways in which those are happening and trying to disentangle them and how monetary policy should respond to that. And we typically think about monetary policy as responding to three things. It responds to the output gap that we talked about. It responds to the outlook for inflation, which can also be affected by these policies, and it responds to changes in the so-called neutral rate. That's the level of monetary policy that's neither restrictive nor accommodative. And so you'd want to be looking at all of these policies and trying to say, okay, what's it doing to each of those three things?
Switching gears, the Supreme Court is hearing oral arguments this morning about whether President Trump had the authority to issue tariffs under emergency economic powers. Under those powers, we've seen many trade deals cemented. The U.S. has pulled in nearly $200 billion in tariff revenue as of September 30th, 2025. If the High Court were to rule that issuing tariffs under those authorities were illegal, and I fully recognize that the administration is working on contingency plans, but what would that mean for the impact on the economy? Would that increase uncertainty, pressuring growth and hiring?
Yeah, so absolutely, something that would affect uncertainty would something that would increase uncertainty over the tariff environment, over the trade environment, is absolutely something that could be a drag on the economy, and that might come as a result of the deliberations you referenced. That type of drag on the economy normally would, all else equal, depending on how the Fed is doing on hitting its two mandates of price stability and maximum employment. But all else equal, in addition of uncertainty from something like that, is something that you would think of us as normally offsetting with moderately looser interest rates. And there's been other sources introducing trade uncertainty in the recent past too. We recently just had another little trade confrontation with China that resolved favorably for the short run, but we'll have to see sort of the durability of something like that as well. But also, the revenues that you mentioned matter because the amount of savings in the economy sort of ties back to monetary policy for thinking about where we set interest rates. And if you have an increase in national savings, it normally is the type of thing that would lead to lower interest rates, along lines that I discussed in a recent speech of mine that I gave a little bit over a month ago. And if that revenue were to go away, then you would sort of naturally think that would have implications for interest rates that would be of importance to monetary policy.
You dissented for the second policy meeting in a row last week, preferring to having cut by 50 basis points instead of 25 basis points. You said you don't think that tariffs are leading to higher inflation, and you'd like to get to a level of neutral on the Fed funds rate faster than your colleagues so as not to do undue harm to the job market.
Yeah.
Are the economy and the labor market at risk given the pace with which the Federal Reserve is proceeding at this point?
So, look, if you look at the summary of economic projections, I think that that most of my forecasts are not really, or most of my projections for where the economy and inflation will go and the appropriate policy that would reflect those, are not that different from, I think, where a lot of the rest of the committee is. The significant difference is that I want to get there faster than everybody else does. It's not that the destination is really all that different. It's the speed with which I want to get there. And part of the speed with which I want to get there is a result of the inflation outlook. I'm more sanguine on the inflation outlook than a lot of my colleagues are, in particular because I don't view tariffs as driving a material amount of inflation, but also because I see shelter and housing market inflation coming down more quickly than many of my colleagues do. That said, to your question, I think policy is too restrictive and that we're too far above where neutral rates would be. And given the state of the labor market, I think that continuing to run policy that restrictive is to also run unnecessary risks. And there are lags with this monetary policy. It's the economy. If policy is that restrictive, the economy doesn't crater immediately. However, if you keep policy that restrictive for a long period of time, you run increasing more and more risks that those lags catch up to you and that monetary policy hits the economy in a really unfavorable way.
To your point, Treasury Secretary Scott Bessent said over the weekend that he believes that there are parts of our economy, particularly housing, that may be in recession already right now because of high interest rates. Do you agree with that?
Well, I think there's always going to be parts of the economy that are relatively stronger or relatively weaker. That's always going to be the case. But we were tasked by the Congress with targeting maximum employment and stable prices in the economy as a whole. And so it's not really appropriate for us to sort of respond to a particular sector of the economy that may be in more or less distress than other sectors. We want to think about the economy as a whole. And I'll go back to what I said before. If we keep rates this restrictive for a long period of time, you increase the risk that the restrictive rates themselves, that is that monetary policy itself, is what causes a downturn in the labor market of exactly the type that we were tasked by the Congress with avoiding.
Chair Powell said that a December rate cut is not a foregone conclusion. In fact, far from it. And he stressed that there's a lot of division on the committee right now as it relates to risks as they view inflation and the job market. What's your sense from the meeting, again, your sense of whether it's going to be an uphill battle to convince your colleagues to cut again next month, let alone cut by 50 basis points?
Well, look, I speak for myself and not for anyone else. But, I think that if you go back and you look at the summary of economic projections that we put out after the September meeting, the median forecast was the median projection was for a third cut this year, meaning a cut in December. So I think the natural question that would follow from that is, has anything changed that would make you change the way that you think about the appropriate policy stance? And the new information that we've gotten since the September meeting, which is not as much as we would like because of the government shutdown, but the new information we've gotten has been, one, that inflation has actually come in below where expectations were for the September CPI print that came out recently. And two, that the labor market continues to be, based on the alternative data that we have, the labor market continues to be on the trend that it was. So given those two things, I would think that it would be consistent with the September summary of economic projections to increase the odds rather than decrease the odds. But that would be according to the median of those projections. And so if that were serious, then I would think that the odds would have gone up. And again, anything can happen between now and December. There could be new information. There could be surprises. There could be shocks. Things that we don't expect could occur. You've mentioned several possibilities. But barring new information that would make you really change your forecast a lot, I would think it would sort of still be a reasonable, a reasonable action consistent with that step to continue on the path that we've been on.
Let's talk about inflation, because the latest CPI report showed that housing inflation actually dropped, which goes to your point that as you expect lower immigration, that will push down demand for housing, bringing down overall inflation. However, services seemed to move sideways. Core services inflation has been running closer to 4% over the past 3 months. So how are you looking at that? Because that's not tariff related.
Yeah, so I viewed that inflation print as consistent with my expectations and as bolstering my case, because so much of my case does rest on housing coming down and shelter disinflation being enough to compensate for some higher run rates in other parts of the index. But that said, if you look at the non-shelter services, I think that it's important to sort of say, okay, what are these services? And the way that the Bureau of Economic Analysis calculates the the price index on personal consumption expenditures, contains some things that it might not be natural to think of monetary policy as targeting. And so we spoke before about how monetary policy balances supply and demand. And there are what we call imputed services in the PCE index. Things like financial services, like portfolio management fees. And the way that gets recorded in the data that the BEA constructs are that if the stock market moves higher, then portfolio managers, asset managers, so forth, they're collecting more fees on the assets they're managing because the value of the assets has gone up. That gets recorded as a price increase in the inflation data, even though you might think of it as more of a quantity increase. They're managing more assets, so therefore, they have a constant management fee. The volume of the assets moves up, and so the overall fee comes up because there's a higher base, but the management fee itself didn't really change. And yet that gets recorded as a price increase in the inflation data because of quirks of the statistical process. But it doesn't strike me that implies a supply-demand imbalance of the type that monetary policy should respond to. Monetary policy shouldn't mechanically respond to an increase in the stock market that could be driven by any number of things. It could be driven by a new technology, like AI. It could be driven by a government policy like removing regulations. It could be driven by any number of possible things that monetary policy might or might not want to respond to, but it shouldn't want to respond to it because of the stock market. Once you remove some of those imputed services like that, and you look at more of a market-based core services or market-based core PCE inflation, it's much closer to 2%. It's like 2.3, 2.4, depending how you slice it.
Before I let you go, Governor Myron, is there a line in the sand on inflation, whether it's CPI, PCE, inflationary environment, that would change the trajectory of getting to the rate of neutral that you see at 2.5%? Or is it that you're saying we should get to 2.5% as fast as possible, and if inflation is not coming down, then we adjust upwards?
Yeah, so as I've said in the past, shelter inflation is such an important part of my outlook for a couple of reasons. One, it's the biggest weight in the indices. Two, it's the biggest weight because it's the largest expense for most people is going to be their rent or their mortgage or whatever. And so, that goes into how people think about the cost of living and how people set their inflation expectations. The cost of housing is really important for people thinking about the cost of living. And my expectations for shelter inflation are extremely benign because market rents have been running at about 1% on a weighted average basis for several years now. And so it's only a matter of time until the official data converge down to the market data. And I think that process is underway, and the recent inflation print, I think, bolstered that view. Now, my view is that the shelter disinflation is enough to compensate for some higher inflation in other segments of the index. If something were to change that made me change my view of shelter disinflation to say, hey, there's a housing shortage again. Rents are moving much higher. The rent, there's going to be a huge increase in rents from where they are now. Rents have been relatively constant, running at a low 1% rate, and that low 1% rate is going to turn into 2, 3, 4%. Then my entire forecast needs to be updated as a result. And if my entire forecast needs to be updated as a result, then I need to change my policy outlook as well. So for me, a lot of my outlook is hinging on this. And if there were some piece of news or data that made me revise that, then I would make that revision, and I think that would sort of flow through my entire outlook into the policy projections as well.
Governor Myron, we'll have to leave the conversation there, but thank you so much for your insights. So appreciate it. Hope you'll come back and see us soon.
Of course, thanks for having me.